Well, good morning, good afternoon, everybody. This is Sean with WickQuidity. Welcome to our supply and demand basics lesson 2. I'm going to try to do some more clarification. I really wasn't happy with my first lesson, but I wanted to get it posted. Kind of rewatched that. Wanted to make some more clarifications on the supply and demand. Most of you probably know this stuff if you've done any sort of supply and demand trading in the past, or if you're in the process of maybe watching some of the other YouTube coaches out there. I'm sure you know some of this information here at the beginning, but as we get into this a little bit down the line here in this video, we're going to get more into some of that low end, intermediate to mid level talk about strategy and supply and demand. So stay tuned. We got some good stuff coming toward the end of the video. Okay, so as we talked about in our first lesson, supply and demand is a really simple concept, right? It is, where did price make a major move from? And when price comes back to that area, will it react? So supply and demand by itself is not trend reliant. Okay, meaning it doesn't matter which direction the overall price is moving, you can still have a valid supply or demand section. Uh, that does not mean that price will respect that supply and demand area when it comes back to it just because it's a valid area, but it does mean that sometimes it will. And you've got to decide on your risk profile and your strategy, is this something you want to trade? For instance, here on the chart, this left chart is a 12-hour chart, and this right chart is a 1-hour chart. This is a common combination that I use. Okay, so there's a lot of supply and demand on this chart, right? You got this area right here in the uptrend. The last little, you have like a little rally, you got a base, and then you got a big rally that clears structure, clears trend lines, liquidity lines, however you want to look at that, momentum lines. Price comes back and rejects very strongly. But also, kind of counter trend. You have this area here, this area here, that we get pretty decent reactions from. Now, I'm not saying you should trade those in either side, but knowing that they can exist on either side of a trend is important. So let's talk about what supply and demand is. So we know it's the consolidation, the last candle before a nice run, or the last set of candles. Like here, you have this rotation in price that creates a base, so you kind of have a drop base drop scenario from some of the old school supply and demand terminology. So what makes supply? What makes demand? Well, it's very simple. Think about it just in basic economics. If you have a ton of supply of something, price goes down. If you have a ton of demand of something, price will go up. So this is a demand area, and these are supply areas. You can also use the term, in my mind, order block. Now, there may be some purists out there that will tell you there are differences in order blocks and supply and demand, but it's 99.99% the same. Okay? The point is to know, to be able to identify these areas as an area of interest to trade from or out of in the future. So here we have with the trend and we have counter trend, and you can see them both potentially working out depending on what you look for from a risk reward, from an entry standpoint, things of that nature. I've also pointed out in these couple that I've drawn the really kind of more obvious ones, but you could also go, supply and demand is a very much fractal thing, right? Price moves in big moves, little moves, all over the market, all time frames. And that's why it's so hard to predict sometimes. I mean, all of these little areas you could call supply and demand. Again, not to say we should trade all of them, but you can see where there could be a ton of opportunity to trade stuff. So, how do we use that? Well, for me, I like to use kind of a multi-time frame confluence on what I do. I also take into account trend because I think that matters. When you want the best risk to reward ratios and the best win rate, trading with the trend helps. It always helps. Trading with the higher time frame trend. So, yes, can you get bigger risk rewards trading reversals? Sometimes you can. Sometimes reversal risk rewards are absolutely insane. However, usually the win rate's lower. I've said in my previous video, I'm somebody that typically trades. My take profits are typically somewhere between 1.5 and 2.5 R. So relatively conservative. But for me, that means I win a lot of my trades. And that's what's good for my psychology in this business. You get to decide how you want to trade that. You can decide to go, you want to decide that you want a 3, 4, 5, 6, 8, 10 R per trade. And you know what? You may make more money than me long term doing so. Very possible. Very likely that you will make more money than me long term. But you will have to have the mental fortitude to be able to withstand losing 4, 5, 10, 12 trades in a row before knocking the home run. That doesn't work for me to consistently do that. That really messes up my psychology. And that was something that took me a long time. I told y'all I've been doing this for over 10 years now. It took me a long time to understand my own psychology and what I needed to be profitable. So let's talk about with the trend. So kind of the way I typically follow my supply and demand is I have two charts here, right? I have my 12-hour chart and then I have my 1-hour chart. And essentially I would use my 12-hour. Now you don't have to use these time frames, but I would use this for trend direction. So we can see this is a pretty nice chart. It is very obviously in an uptrend. So in that case, I would only be looking for demand zones within my 1-hour chart. Now, is every demand zone going to hold? Absolutely not. Anybody that tells you otherwise is lying to you. But there will be plenty of good trade opportunities and clearer targets if you trade the demand zones on the lower time frame inside a higher time frame uptrend. Again, you can decide how fractal you want to go with it. Doesn't matter. What matters is you have a clear strategy of which ones you will take and won't take based on your risk reward, your risk profile, your entry mechanisms on your lower time frames. So for me, when I'm trading the 12-hour as my trend, the 1-hour looking for my supply and demand and other setups, my entry time becomes the 5-minute. And if you'll notice something, that is a 12 multiple all the way down, meaning there are 12 1-hour candles in a 12-hour, and then there are 12 5-minute candles in a 1-hour. So it keeps kind of the ratio of data on the chart similar, actually identical in that particular case. Now I do have another set of time frames that I trade where it's not perfect like that, but it doesn't have to be. But just to give you an idea, you don't want to be somebody that trades a daily chart and then trades as a trend direction, and then trades a 1-hour chart as looking for setups, but then uses a 15 or 30 minute for entry. There's not enough data to make those correlate properly. Not enough of the multiple there. You want to have similar multiples. So for you guys using TradingView, it's very easy because you can do lots of custom time frames and things of that nature. For some of you Forex traders or traders on other platforms, like for instance on MetaTrader, especially on MT4, you've got a very limited selection of time frames. So you could do something like the 4 hour and then the 15 minute and then the 1 minute. And that would give you 3 time frames that correlate very well. You got 16 15-minute candles in a 4 hour candle, and then you got 15 1-minute candles in a 15-minute candle. So it correlates very, very well. That's important to understand if you're going to trade my strategy as we go on. Now, you may can develop a different type of entry strategy, and your time frame, especially your entry time frame, maybe you can do it without having such a big multiple there. Okay, so we've talked about defining the difference between supply and demand. We've talked about trend versus counter trend. We've talked about time frames as far as the multiples. So when you combine those things, what I noticed in my own trading, okay, and again, this is with my specific entry rules and my specific risk-reward rules and things of that nature, is there was a significant percentage of trades won when I only traded with the higher time frame trend versus trying to catch the counter trend moves. So that is typically how I trade, unless there's some big economic news that tells me that, hey, maybe we're going to go for a short here for a while, and maybe my higher time frame hasn't caught up with it yet. Sometimes I will trade counter trend in that manner, but generally speaking, I only trade with the higher time frame. Now, how do we identify the trend on a higher time frame? That's very simple, and I'm going to break that down into a separate video. Before this thing's said and done, I'm going to have 4 or 5 playlists for you guys to watch. There's going to be a supply and demand playlist. There's going to be a liquidity playlist. There's going to be a market structure playlist. There's going to be a key levels playlist. And each of these playlists are going to have somewhere between 2 and 5 videos for you to watch kind of in order. And then at the end, there's going to be kind of a putting it all together playlist where there's going to be 1 or 2 videos really breaking down how to absolutely combine all of these teachings, all of this theory that I have into one cohesive trading ideology. And that is important for you guys. So, trading with the trend. So here, this one's pretty obvious. They're not always this obvious. And maybe in real time, you get this big move down here. Maybe you're questioning whether we're still in a uptrend or a downtrend, or have we moved to a downtrend. I like to use structure. So like, yes, for me, a couple candle closes there under that structure would tell me I'm probably in a downward move. So somewhere around here, I would be looking to start selling. And I'm not saying that you're going to win 100% of your trades. That's never going to happen. But I might have been interested right here because we've broken down and we've got a pretty clear supply zone here. We've got a return to it. At this point, I might have looked to my lower time frame and looked for an entry reason to see if I couldn't catch that move short. But then that move was relatively short-lived. As on the higher time frame, we started moving on back up. And here we are at all-time highs. And I've posted a few of these on my Facebook page, which is Sean Trades WickQuidity, where I've shown some screenshots of these trades on gold that I've been in. Gold's been very good to me over the last few weeks, especially in the Asian session, which is unusual for me. I've caught quite a few trades on gold in the Asian session over the last week or two, where it's just been constantly pushing to those new all-time highs. Okay, so again, very, very brief video. So take what you've learned here, just about how to identify proper supply and demand zones. Go to your chart, back test. That is so important for you to be able to establish your trading style, your risk tolerance, and things of those natures. You have to go back and back test. And what I tell people when it comes to back testing is, most people see a setup and go, "Oh my goodness, that works. Let me see if it works over here." And they try to force it, and they look at the places where the setup works, and they forget to intentionally look for the places that their idea fails. Make sure when you're back testing that you look for where your idea fails specifically. If you guys are trading Forex, okay, where you got to deal with those little bit higher spreads and stuff, if price goes down to your take profit, where you would put your take profit, and it doesn't cross it by 2 or 3 pips at least, especially on non-US pairs. If you're trading pound Aussie or pound New Zealand or some of the really exotic stuff or crypto, you got to think about the spreads, right? And so if it's not crossing your take profit in your back testing properly, like to know that you've cleared your spread, then you should count that as a loss in your back testing. Okay? So come up with a plan specifically on how you target things. Are you targeting a fixed risk to reward? Are you targeting a previous structure? Are you using fibs? Or what do you like to do? And again, I'll get into mine a little more. I use structure for pretty much everything. But I will get into mine a little more as we get into those later videos. But you've got to figure out what you like, and you have to test different things in different scenarios. If you're coming into trading looking for this to be a show me when I can press the button every single time so I can be profitable tomorrow or next week, that's a tough ask. Most people never become profitable in this business. And the people that do, it often takes them a long time. It took me years and years and years before I think I was 5 years into trading before I even become a reasonably break-even trader. And then another year or two before I became, relatively profitable. And here we are 10, 11 years into this thing, and now I'm consistently profitable. So, that being said, do your research. Go draw your supply and demand zones. Test them with your higher time frame trend. If you're not good at the structure stuff yet because you're new, you can use things like moving averages. Put you a 100 moving average on a chart. Or it don't have to be a 100. It can be whatever number you like. There is no such thing as a best moving average or a best setting on an indicator. Why is that like that? And say that when price is above the 100 here on my higher time frame, I only take longs on my medium. I only look for setups on my medium time frame to buy. So there's you could do that, or you could come up with some other indicator that you like to determine your trend on your higher time frame. But whatever you do, do it consistently. Back test it 100 times on 4 or 5 different instruments that are not related. Meaning, if you do the S&P, don't also do the NASDAQ. Right? Find you some different stuff. If you do gold, don't also do silver. They move very similar. They make big moves kind of together a lot. If you're going to do crypto and you're going to do Bitcoin, don't do Bitcoin and Ethereum. Because Bitcoin drives that market, and you're going to get a lot of positives at the same time between the two, but maybe miss a time when you would be losing multiple trades between the two. So pick you 3 or 4 things. Pick you the NASDAQ. Pick you oil. Pick you gold. Go do pound Aussie and in New Zealand JPY if you're a forex trader. Things that are kind of uncorrelated. Pick you 3 or 4 or 5 of those. Back test your supply and demand zones 100 times each. Track the data. Track the data when it's pro trend, when it's counter trend. Come up with some other ways that you can, have different variations in data. Maybe you identify specifically when you're in a range bound market. Maybe you identify areas that you're only taking supply and demand zones that are also overbought, oversold on the RSI, if you like indicators. Come up with 2 or 3 sets of rules to trade on 2 or 3 or 4 different instruments for 100 times. And you should have 1,000 trades between those. You can log that. You can say, this is my statistical edge if I follow these rules. Once you establish your statistical edge, it's game over. Now it's just executing. And as time goes on with my training videos, we will go over more and more, and I will teach you everything about how I trade. But that would be a 10-hour video, and nobody's going to sit down for 10 hours and watch one video. So, that being said, I really look forward to you guys. If you have any questions, comments, concerns, please drop a comment. I would love to respond to some comments. Share the video, like it, subscribe. I know this is a really quick, very basic stuff. I'm trying to kind of slow roll this, both for you guys and for me, because I'm, as you guys know, it's a relatively new channel. So I'm trying to kind of piece this together and see, what we can do, what little steps I can take at each point in time to help you guys learn and to keep my content succinct, and yet be able to put out enough stuff. So, supply zones are what? Supply zones are where, when you have too much supply, price goes down. So supply zones are always on the high side of price. Demand zones are when you have too much demand, price goes up. Demand zones are always on the bottom side of price. Combine that with trend on a higher time frame, and now you've got a start of an actual strategy, of an actual trading methodology. Look forward to seeing you guys on the next video. Y'all have a wonderful day.